My name is Rika Eckhoff. I'm the Nordic editor of Unquote, and I am delighted to be here with Louis Elson, co-founder and managing partner of Palamon Capital Partners.
Thank you.
And Louis, Palamon is a growth investor. How would you define the term growth capital?
Growth is about simply backing high-impact entrepreneurial managers to manage businesses to an extreme level of high top-line growth. There are many ways of doing this, many different models out there in growth. For us particularly, it's about seeking out an investment thesis in particular subsectors of industries where we can see what we like to call wind to the back, and then supporting those companies and the managers who manage them in order to catch that wind and really capture that high level of growth.
But now, with sort of the lack of readily available debt, it seems that some buyout houses are reshifting their focus towards the concept of growth. Would you say that the growth capital model is a safer option than, say, the LBO model?
In my view, safety is not a function of the model. It's actually a function of the execution of that model. And there are different firms with different points of view and different ways of operating their systems where they can actually create safety in whatever environment. However, I can say this, in my 20 years of experience in private equity, what I've seen is consistently growth has provided higher returns on a more consistent basis over longer periods of time.
But surely growth capital requires longer holding periods.
It does. It does. One of the parts of growth capital is making sure that you have enough time to really allow that company to pick up and take off. In our case, it's around 5 to 7 years holding period, which is quite different than a plain vanilla LBO model, but also important because it allows us to really pick up those growth rates over a longer period of time.
And just speaking of discipline, I mean, many academics would argue that if you add leverage to the capital structure, then you induce managerial discipline.
Leverage is an important point of discipline, no question about it, and I agree with that. On the other hand, you can have over-leverage, and in the case of growth companies, that can actually suffocate a company from being able to grow. One of the things that you need to get the balance right in growth capital investing, by the way, which is somewhat difficult for plain vanilla LBO houses to try to move into, one of the issues they will have, is you've got to give it the room to actually be able to capture that growth rate. When I'm explaining it to investors, I tend to talk about it graphically, as most private equity investors like to do, and to think about it as two different types of curves. In a standard LBO model, you get high value add early, and then it begins to taper off as you go over time, primarily because a lot of the initiatives that happen early, operational efficiencies, changes in capital structure that give real benefit very quickly to a particular investment situation. For growth, it's different. For growth, you actually will, at the very beginning, the classical J curve, you'll begin to almost destroy value as you reset the structure of the business, and then as the top line grows, you grow your way into higher and higher growth as you move farther out the time scale.
But about half of your investments have a debt component. But even with low levels of debt, with a J curve, how do you sell this business case to the banks?
Interesting, correct. Half of our companies are levered, but also interesting is the half that are levered, half of those were not levered at the start. So we had to step into an all-equity situation, begin building the infrastructure for the growth that we were expecting, and then going back to the banks and asking them to add more debt into the capital structure. Now, importantly, we're as afraid of the debt as the banks. Which is an important point because they understand that what we're really trying to do is not generate returns from the leverage, but use the leverage to increase secondary returns because the growth is what's actually going to drive returns over time.
And what other challenges do you see for growth capital investors, particularly now in the current environment?
The biggest issue today for all investors is uncertainty. It's one of the first times in my investing career that I've seen that the bulls and the bears are almost exactly 50-50 aligned, and each has arguments that are very compelling about why things are going to be fine and why on the bear side things are not going to work out. And that's a very, very difficult problem for growth equity investors because, again, going back to what I started with, you need to have a point of view about what's going to happen. You need to be able to feel that wind to make sure these companies can grow at these excessive growth rates. If you don't have that certainty, it makes it very difficult to make that kind of commitment. The second problem that the uncertainty brings is the classic buyer-seller gap. We're seeing it persist. It's been around now for 18 months. I believe it will continue for quite a period, again, because the uncertainty allows a buyer to say it's not going to work out and bring the multiples down, and allow the seller to say, I think it's going to be fine, and I'm not going to sell my business for any less than X. That presents a third problem for growth equity investors. Growth equity investors tend to be very optimistic by nature. They believe that the growth will continue. In fact, it may be even endless. And that keeps them, in fact, from selling immediately. They tend to want to hold a little bit too long. So exiting is going to be an issue as growth investors are quoted multiples back for their companies that they think are not good enough for the growth rates of the businesses they own. They're going to say, well, maybe I'll just hold another year. Well, maybe because the growth rate will continue, I'll be fine anyway. And you'll start to see some of them pull back when, in fact, they've got to be brave and begin pushing forward with trying to exit positions.
Because surely your LPs will be pushing for some realizations as well. And I mean, it's been vastly reported, sort of the strain this crisis has put on GP-LP relations. How has that affected growth capital and their LP relations, you think?
Well, I can only speak for us, and in fact, things have been very, very good. Primarily because, again, we've been practicing this kind of equity investing, growth equity investing for now 2 decades, in my case. And the investors can see that we know how to invest through the cycles. But exits are very important. These LPs have future commitments to other funds. We hope future commitments to our fund, and they need the capital back to be able to make those commitments. So we're going to have to find ways of getting exits to happen. In particular, again, for growth equity, since we've been holding companies for a significant period of time, it's time that we start to harvest and bring capital back to LPs. It will continue to be an issue, clearly for the industry as a whole, and specifically for growth equity firms that have been holding on to positions for a long time, which they tend to do.
So finally, your advice to funds out there, now struggling or not struggling, what would that be?
I think the big issue, again, is strategy drift. I think that LPs understand this. I think GPs understand it intellectually, but not emotionally. You really do need to stick to what you're doing. And one of the issues that a lot of private equity firms have in these kinds of times of crisis is they tend to think, well, maybe the grass is greener on the other side. I think I'll try to be this, or I think I'll try to be that. And as I've said before, it's not really about the model. It's about the execution of the model and how you're specifically set up to execute a strategy safely, convincingly, and for the long term.
So your advice to fund managers out there is pretty much stick to your guns.
Stick to your knitting. Stick to your knitting.
Louis Elson of Palomon Capital Partners, thank you very much. I'm Rick Eckhoff from Nordic Unquote. Thank you very much for watching, and join us again next time.